Welcome to Japan Market Brief, the daily English audio update on what moved Japan's markets and what matters next. April 3rd looked calmer on the surface, but the stress underneath Japan's market was still easy to see. The Nikkei 225 rose 1.26% to 53,123.49. That was a respectable rebound after the prior session's weakness. But the market's deeper signals were not especially comforting. Dollar yen remained high near 159.61. And Japan's 10-year government bond yield briefly rose to 2.395%, the highest level in roughly 27 years. So while equities recovered, investors were still dealing with a stronger funding and logistics stress story beneath the headline index move. NHK reported that the Nikkei at one point rose more than 900 yen as names sold the previous day were bought back. That tells us the rebound was at least partly technical. It was a stabilization move, not necessarily a sign that the market had become confident again. In other words, buyers came back, but they did so in an environment that was still full of warnings. The currency was not helping much. Long-term rates were moving higher, and the energy and transport backdrop remained sensitive to Middle East developments. That is why today's session matters. It showed Japan can still rebound, but only inside a market that remains alert to macro stress. The rate story was arguably the most important domestic macro signal of the day. The rise in the long end of the JGB curve tells investors that financing conditions are becoming tighter, even if the Bank of Japan is not trying to shock markets with abrupt rhetoric. For equities, that creates a difficult balance. If yields keep climbing, valuation-sensitive sectors can come under pressure. If yields rise because inflation and supply concerns are being taken seriously, then the market has to price a more restrictive environment even when stock prices look calm for a day. At the same time, dollar yen staying near the upper 159s means the foreign exchange side is still not resolved. The market is not back in a full panic about 160, but it is close enough that traders cannot ignore the possibility. Today's stock to watch is Mitsui O.S.K. Lines. NHK reported that an LNG carrier tied to Japan passed through the Strait of Hormuz after military operations, making it the first Japan-related example highlighted after the latest escalation. That is important because it turns a broad geopolitical story into a concrete logistics story. Mitsui O.S.K. Lines is not just a shipping company in this context. It is a way to watch how energy supply routes, tanker traffic, insurance risk, and transport costs may feed back into Japan's economy. This is where the market theme becomes more specific. Japan's concern is not only oil prices. It is also whether fuel and materials can keep moving efficiently and predictably. If the market begins to focus more on physical routes and freight exposure, shipping names can become much more informative than the broader index. That makes MOL worth watching even on a day when the Nikkei itself is higher. The index can rebound while logistics stress remains unresolved. For the next session, watch three things closely. First, whether the Nikkei can remain above the rebound zone rather than fall back into another sharp reversal. Second, whether long-term Japanese yields keep grinding higher. Third, whether the Hormuz and broader shipping risk story starts calming down or becomes even more central to how investors price Japan. If shipping stress fades and yields stabilize, Japan's equity rebound has room to extend. If not, then today's rise may look more like a pause than the start of a cleaner recovery. That is all for today's Japan Market Brief. Thanks for listening.